Hi, good morning. Ross McInnes from Australian Investment Research Services. Thanks for joining us. It's Monday morning, June 7th at 8:30 a.m. in Sydney. Markets had a big sell-off on Friday night, continuing the theme we've had for the last 6 weeks of new concerns about a potential double-dip recession in the global economy. This was driven by US payrolls numbers, which the market had fairly optimistic expectations of the numbers, looking for over 500,000 increase, which represented the biggest rise in the last 25 years for 1 month. And this was driven by the expectation that the government decennial census would ramp jobs up. In the actual release, this did happen. There were 411,000 jobs created by the census during the month of May. But unfortunately, the private sector payrolls, which have been running at about 160,000 per month over the previous 2 months, only came out around 41,000, and this gave the market more ammunition for the view that potentially things are slowing back down again. Also over the weekend, what we had was a G20 finance minister meetings in Korea. This continued the theme of governments wanting to re-regulate the financial markets and also the banks. It looks like we're definitely going to get increased capital restrictions on banks and guidelines, and also a range of other market changes that are coming forth. Those reports should be out in the next couple of months, and the June 26th, 27th G20 meeting of the leaders is on in Toronto, so that'll be a key focus in the second half of June. Okay, so the theme's continuing, as we noted, about the last 6 weeks. Eurozone sovereign risk got another fillip on Friday night from the fact that they looked at Hungary now as potentially a Greece-like situation. The government there tried to hose this down, but this contributed to the Euro-USD rate again falling to new 4-year lows. It fell 10 days ago to 121.10 area. On the way into the payrolls, it broke down through 120.50 and closed Saturday morning around 119.73. It's opened this morning around 119.25.30, and it's taken the Australian dollar back down as well. The Aussie last week pretty quiet between 82.80 and 84.50 range, but it's opened this morning down at 82.35. Noting that the big sell-off down to 80.60 was just over a fortnight ago, but the market is stabilising off these levels. So key issue at the moment is that the equity markets are effectively in bear mode at the moment. The ASX 200 is expected to open down at 4350, which will represent around a 14% fall from the mid-April highs, just around 5,000 on the ASX 200 index. It's going to be a big week ahead in terms of whether this market can stabilise again. Our view is that it still represents value, but we face this short-term and potentially more medium-term negativism in the market, and numbers this week are going to be crucial for that, and also government policy decisions. We've got the run of Chinese data on Friday, Australian labour force on Thursday, and US retail sales on Friday night as the key focal points from an economic data point of view. And noting that we also have a run of central banks reporting and making decisions on interest rates, which includes ECB, Bank of England, Reserve Bank of New Zealand, the Bank of Korea, and all on Thursday. So very important week ahead for financial markets and policymakers. The Australian government's still under a lot of pressure from the resources tax, with the latest poll this morning saying that suggesting that if they ran an election today, that the current Labor government would be voted out and Tony Abbott's Liberal Party would come in. So thanks for joining us, and we'll speak this afternoon. Bye bye for now.